2026 is shaping up to be an intriguing year for investors. The global economy is evolving rapidly, markets are shifting, and opportunities are popping up everywhere. But here's the catch: not every investment is created equal. The pros are looking carefully at trends, data, and risk, because they know that a smart bet today can become tomorrow's wealth, while a hasty decision can cost you big. Let's break down what savvy investors are focusing on this year and how you can think like a pro without overcomplicating your strategy. Technology in 2026 is moving at a pace that can feel almost overwhelming, but for savvy investors, this acceleration is a goldmine of opportunity. If approached correctly, the landscape is no longer limited to the traditional giants like Apple, Microsoft, or Google. Instead, the market is being reshaped by a host of emerging sectors, each offering the potential for massive growth, but only if you know where to look. Artificial intelligence, renewable energy technology, and advanced semiconductors are among the areas attracting the most attention from professionals. These are not just buzzwords, they represent real innovation that is transforming industries, creating efficiencies, and opening entirely new markets. Artificial intelligence, for example, is infiltrating nearly every aspect of business, from predictive analytics that help companies forecast consumer behavior to AI-driven healthcare solutions that can detect diseases earlier and more accurately. The applications are vast. Investors who identify companies developing AI software, cloud-based AI platforms, or specialized hardware that powers machine learning are placing their bets on growth that is likely to compound over the next decade. But here's the critical nuance: not every AI company is worth the hype. The professionals look for firms with clear revenue models, patents or proprietary technology, and a track record of execution. A flashy idea is not enough. The business must have a pathway to monetization and a competitive moat that protects it from copycats. Renewable energy tech is another sector where smart investors are positioning themselves. Solar panels, energy storage solutions, wind turbines, and other clean energy technologies are benefiting from a combination of government incentives, increasing corporate commitments to sustainability, and consumer demand for greener alternatives. Professionals are particularly focused on companies that are innovating in energy storage, battery technology, grid solutions, and efficiency improvements, because these areas solve the core challenge of renewable energy intermittency. Investing in companies that are not only producing clean energy, but also enabling its effective storage and distribution is a strategy aimed at long-term gains. Semiconductors, often overlooked by casual investors, are crucial to the technology ecosystem. From powering AI algorithms to enabling electric vehicles and smart devices, semiconductors are literally the foundation of modern innovation. Companies that design cutting-edge chips or manufacture specialized components for AI, cloud computing, or automotive applications are seen as high-value targets for investors who understand the long-term demand trends. With global supply chains evolving and governments prioritizing domestic chip production, the semiconductor sector is positioned for growth, but it requires careful selection of firms with technological advantage and operational efficiency. The takeaway for investors is clear. Technology investing in 2026 is about precision, not speculation. Professionals are not buying into every shiny new startup or hype trend. They're identifying companies that have a clear advantage, sustainable growth prospects, and a business model capable of weathering market volatility. By focusing on innovation that solves real problems, demonstrates scalability, and has a competitive moat, investors position themselves to capitalize on transformative growth while mitigating unnecessary risk. In short, the technology of 2026 offers enormous potential, but success will go to those who are selective, disciplined, and data-driven in their approach. Diversification is often described as the only free lunch in investing, and in 2026, it is more critical than ever. Markets are expected to experience heightened volatility due to a combination of inflationary pressures, geopolitical tensions, and technological disruption. For investors looking to grow wealth while managing risk, diversification isn't just a strategy, it's a necessity. Spreading investments across different asset classes, sectors, and even geographic regions helps to mitigate the impact of any single downturn and creates a smoother, more resilient portfolio. Many new investors make the mistake of putting all their money into a single stock or sector, chasing a quick win. While that approach can sometimes produce short-term gains, it carries enormous risk. A diversified portfolio, on the other hand, balances potential upside with protection against losses. For example, pairing high growth technology stocks with dividend-paying blue chip companies introduces stability without sacrificing long-term growth. Blue chip stocks may not skyrocket overnight, but they provide consistent returns and a buffer during turbulent market periods. Bonds are another essential component of diversification. Treasury bonds, municipal bonds, or corporate bonds offer predictable income and are less volatile than stocks. In uncertain economic times, bonds act as a safety net, helping investors preserve capital while still earning a return. Even in a low interest rate environment, bonds provide stability that complements the higher risk segments of a portfolio. By blending stocks with bonds, investors can manage risk while still participating in potential market growth. Real estate is another area that professionals include in their diversified strategies. Rental properties, real estate investment trusts (REITs), and commercial real estate can generate steady cash flow while also appreciating in value over time. Unlike stocks, real estate is a tangible asset that often moves independently of equity markets, which makes it a valuable hedge against volatility. Smart investors in 2026 will look for properties in growing regions, consider the impact of inflation on rental income, and evaluate long-term trends like urban migration and remote work to select the best opportunities. Alternative investments, while less conventional, are also playing a bigger role in a diversified portfolio. Commodities such as gold, silver, and agricultural products often perform well during inflationary periods, providing a counterbalance to equities. Emerging market funds, private equity, or niche sector ETFs allow investors to access growth opportunities that aren't available in traditional markets. Including a portion of these assets, proportionate to risk tolerance, helps investors capture upside potential while spreading exposure across multiple areas. The key to diversification is not simply owning a variety of assets, but owning a thoughtfully structured mix. The goal is to reduce the risk of catastrophic losses while positioning your portfolio to grow steadily over time. Diversification doesn't guarantee you'll avoid losses entirely, but it ensures that a downturn in one sector won't wipe out your entire wealth. In 2026, with market unpredictability likely, spreading your investments across multiple sectors, asset types, and geographic areas is one of the smartest moves an investor can make. By following this principle, you can approach investing with confidence, knowing that your portfolio is resilient, well-balanced, and prepared for both opportunities and challenges that the year may bring. Inflation has a way of quietly eroding wealth, and in 2026, it remains one of the most important factors for investors to consider. Even a seemingly modest increase in inflation can dramatically reduce the purchasing power of your money over time. That's why professionals are focused on inflation-proof investments, assets that either grow in value as prices rise or maintain their real purchasing power. Ignoring inflation is one of the biggest mistakes an investor can make because without protection, even a well-diversified portfolio can lose value in real terms. Treasury inflation-protected securities, or TIPS, are a classic example of an inflation-resistant investment. These government-backed bonds adjust with the Consumer Price Index, which means that both the principal and interest payments increase with inflation. For investors seeking a low-risk method to preserve their capital, TIPS offer peace of mind while still providing a return that keeps pace with rising prices. Unlike standard bonds, which may lose value in an inflationary environment, TPS are specifically designed to protect your money from being eroded by inflation. Real estate is another powerful tool for combating inflation. Property values tend to rise over time, often at a rate that exceeds inflation, especially in high-demand areas. Rental income can also increase with inflation, providing a cash flow stream that maintains its purchasing power. Investors are particularly drawn to multifamily properties or commercial real estate in growing regions because these investments can offer both income and long-term appreciation. Even in times of market volatility, real estate has historically remained a strong hedge against inflation, making it an essential component of a well-rounded portfolio. Commodities, such as gold, silver, oil, and certain agricultural products, are also considered effective inflation hedges. These tangible assets often gain value when the cost of goods rises, acting as a counterbalance to declining purchasing power in cash or fixed income investments. Precious metals like gold have long been trusted as a store of value during periods of economic uncertainty, while agricultural commodities can benefit from increasing demand and limited supply. Including a portion of commodities in a portfolio provides diversification while directly protecting against inflation's impact. Certain dividend-paying stocks can also help investors stay ahead of inflation. Companies with strong pricing power, those that can pass increased costs on to consumers without losing market share, often see their earnings grow even when overall prices are rising. Sectors like consumer staples, utilities, and healthcare frequently demonstrate this resilience. By focusing on companies with reliable dividends and pricing power, investors can create a portfolio that generates income while offsetting the loss of purchasing power caused by inflation. The key lesson for 2026 is that protecting against inflation requires proactive planning. It's not enough to simply invest in traditional stocks or bonds without considering how rising prices will affect your returns. By incorporating TIPS, real estate, commodities, and carefully selected dividend stocks, investors can preserve and grow their wealth even as the cost of living increases. Professionals approach inflation strategically, seeking assets that maintain value, provide income, and offer long-term growth potential. Following this approach ensures that your portfolio is not only resilient to market fluctuations, but also shielded from one of the most silent threats to wealth: inflation itself. Every year, certain investment trends capture headlines, drawing attention from the media, social platforms, and retail investors. In 2026, emerging sectors like artificial intelligence, electric vehicles, biotechnology, and climate-focused solutions are generating a lot of buzz. Professionals closely monitor these trends because they can indicate areas with significant growth potential. However, the key difference between casual investors and seasoned professionals is how they approach these trends. It's not about following hype blindly, but using data, research, and disciplined analysis to make informed decisions. Trends provide a starting point, a signal that something is gaining momentum, but they aren't a guarantee of success. For instance, electric vehicles have been discussed for years, yet not every company in the sector will thrive. Investors must distinguish between firms with real competitive advantages and those riding the wave of excitement without a sustainable business model. Professionals examine factors like production capacity, technology differentiation, regulatory advantages, and market share to separate genuine opportunities from temporary fads. This careful vetting process ensures that they are not investing in buzz alone, but in companies with long-term viability. Biotechnology is another trend attracting attention in 2026. Advances in gene therapy, personalized medicine, and pharmaceutical innovation are creating enormous potential for growth. However, biotech can be highly volatile because of regulatory hurdles, clinical trial risks, and lengthy development timelines. Professionals in this space focus on companies with a solid track record, promising pipelines, and the ability to navigate complex regulatory environments. They also diversify within the sector to mitigate risk, understanding that a single trial failure doesn't derail their entire strategy. Artificial intelligence continues to dominate investment conversations as it transforms multiple industries, from healthcare to finance to logistics. Investors pay attention to both the software companies creating AI applications and the hardware providers enabling AI's infrastructure. The pros analyze adoption rates, revenue growth, and scalability before allocating capital. They often combine AI investments with other areas of their portfolio, balancing high growth potential with more stable, lower risk assets. The overarching principle for 2026 is to follow trends, but always back them with research. Professionals gather data, study industry reports, evaluate financial statements, and consider macroeconomic conditions before committing funds. They ask questions like, is the company positioned to dominate its market? Does it have a clear path to profitability? What risks could disrupt growth? This disciplined approach ensures that trends are leveraged as opportunities rather than speculative gambles. In essence, trends are valuable signals, but actionable investment decisions come from thorough analysis. By combining trend awareness with research, risk management, and diversification, investors can position themselves to capture upside potential while avoiding costly mistakes. The most successful investors in 2026 are not the ones chasing the loudest headlines. They are the ones who identify meaningful opportunities within emerging trends and back them with informed, strategic decisions. Following this approach allows you to participate in the most exciting sectors of the year while maintaining a portfolio that is balanced, resilient, and designed for long-term success.